Hello there, hope you're doing great as always. So let's get deeper into investing today. Let's jump right into it because the reason for this video is to drive actual real change, right? Because this is not kind of a video where it's just, kind of the entertainment kind of thing, but it's actual, hey, like how to do it step by step, right? What's, let's figure it out. Let's figure out how we can be better, how we can, make that real change, how we can become, 10x compared to what we are today in 10 years time, right? Because we all have that potential, right? Whether we have our first 10k in the market, 100k, if we have million, if we do things right, it can be 10 times as big in 10 years. It's not easy, but it could be simple, right? Because again, it just comes down to principles and doing all of the steps, right? Doing what's required, not just what's convenient. So last time we spoke a little bit about, investing overall, why it's important. But now let's get even more practical, right? And let's also see what's possible. So as we basically talked last time, right? Path to become better investor, understand the market and multiply wealth is simple, but not easy, right? We have to have that discipline, having some, of course, capital to deploy, right? But we also don't need some of the things that people often think that, when we want to make a lot of money, we need to be genius, spend a lot of hours studying. No. Like, yeah, I'm probably a little smarter than the average guy, let's say. At least I like to think so. But I'm no genius, and I've met some people that are like wicked smart in my life. But you don't need it for investing. No, not really. You just need to, learn the principles, stay in your lane. Don't try to be too smart, right? Because actually sometimes it can even be to our detriment, right? Because oftentimes the people that think they are the smartest think they are smarter than, the market. And, let's say and I'll just give you a quick example, right? Because oftentimes, short sellers, people going against the companies, they just, they want to be right. They want to be right very, very hard, and they basically burn themselves because that they think they are too smart. So don't try too much, right? Don't try to be too smart. Don't try to time the market too much, right? So it's also like, understanding where is the limit, right? So basically what I would say, based on those 80 years of my experience, and of course, of everything that I've learned from, other people, from books and everything, as a retail investor, picking individual companies, being more deliberate about it, sure, we should expect some time commitment. I would say, 5-10 hours a week is decent amount, right? Shouldn't be more than that. But it also probably can be done with, just like a casual 1 hour here or maybe 2 hours here, watching some YouTube videos. That's probably not gonna cut it, right? Because sure, you might get some, good ideas from here and there. But it's actual real work, right? If it was easy, everybody would be doing it, right? So we shouldn't underestimate it, but we don't need to overestimate it either, right? So once again, it comes down to principles, building our portfolio. So of course, initially we need to, do a little bit more when we are learning, how to do it, in our first year, first 2 year, first 3 years, do that real work. Like someone who would, go to a college, to a university, right? Learn. That's also, solid 2-3 years of learning, right? And of course, once we are more experienced, we can a little bit more like manage and maintain mode, especially when our portfolio is established, right? Because someone who already has that, let's say $1 million plus portfolio, lots of the positions are, mature, well established from the previous years. Well, as long as we've chosen the right companies, right? And we just want to, keep them growing, then we don't need to do that much in, let's say, year 5, 6, 7, with that little caveat. As long as we did proper work before to establish that foundation of our portfolio, right? And, to take the whole principle a little further, there are, of course, many millionaires, multimillionaires that have multiple, ventures, businesses, right? And stock market is just one fraction of their overall attention bandwidth. And that should also be your mindset, right? Like all of us, we have work, family, hobbies, you name it, right? Maybe we have some side projects going on. That should still be part of our life, right? It's just investing is that thing that runs in parallel. It's important, but it should not overtake our life, right? So yeah, put some solid 5 hours in, but don't let it overtake our life. And of course, we need that initial capital, right? As Charlie Munger said, the first 100K is hardest, 100% true, right? And I would say, of course, he said that, I don't know, 30, 40 years ago, right? So if you adjust it for inflation, it's probably like the first 200, the first 200, 250K is usually the hardest. So that's also why, you know, those initial years are important, right? Because we should put that initial capital, which will come from our earned income. And sure, you know, like we can just start with like 100 a month, learn the ropes. Sure, it's cool. But in order to make this meaningful path, we should be deploying at least 500 a month. 500 a month as a minimum, because, and actually very recently, I was just reviewing some of the notes from back in the days, right? So when I was actually starting to invest back in 2018, 19, I dug up some of my old, notes, because back then, again, I was just a student, 8 years ago. So I was kind of budgeting hard, really making sure, every dollar is spent wisely. So this is how my income expenses looked in 2019, right? When I was studying, working in a restaurant, basically full time, like 4 or 5 evenings a week, some overtimes, from like 4 or 5 until midnight, right? So it was basically a full time job, right? Which meant that, I've even back in the restaurant, like being student, 3,700 of an income, that's solid, right? That's like a full time adult job, right? Even though I was still studying. But from those, what's even more important is that from those 3,700, I invested over 2K, right? Because my rent was relatively minimal. It was just the tiny studio apartment. It was just one freaking room. Well, I was a student. I didn't need anything, right? And of course, food. I was working in a restaurant, so I wasn't spending that much on food either. And then some other, miscellaneous stuff. Cool, right? And of course, you have to adjust it for your situation. But that's also an important point, right? Either when you are a student, you really don't need much. Find a way how you can still invest at least 1,000 even as a student. It's very much possible, right? We just have to be a little bit more inventive and don't spend on some stupid stuff. Because even back then, I knew that, let's say, every 2,000 that I invest back then, almost a decade ago, I knew that 2,000, I can turn it at least into 20,000 in that decade, right? And even more the further we go on a timeline, right? So think about it that way, right? Because that 1,000 that you're investing this month, well, if you're investing it wisely, it's going to be 10,000 in a decade, right? So is it really worth it to spend that extra 1,000 on whatever, if it's worth, 10 times as much? It wasn't for me, right? And this is how it ended. And of course, you can adjust it based on where you are in your situation, right? Because sure, maybe you're already an adult, right? You're having family and everything. So you probably have, much more expenses, right? But you're probably also making more money, right? Because of course, as you upskill yourself, you're making maybe, 4, 5, 6K a month, maybe more, right? Maybe, making 6 figures a year, cool. But still keep the discipline, right? That we should be investing at least 1,000. Of course, the more the better, but at least 1,000, right? Because if we invest 1,000, that's giving us that, very real shot for million in 10, 15 years, right? Should be the minimum. And so, from there you can grow to that 6 figures within a couple of years and 7 figures in a few more, right? So that's why it's also important to deploy some, real money there, right? 500 a month minimum, should be 1,000, in my opinion. At least that's what worked for me, right? So hey, you don't have to do what I've done, but if you want the results I'm getting, well, you have to, do the steps. So yeah, and let's start from the beginning, right? And understand some of the most important, well, basically the most important formula of investing. Investing trifecta. That's, I mean, of course, like I invented the name, right? But it's a simple principle. So in the game of asset accumulation and appreciation, there are three important forces that influence your outcome. Listen carefully, right? Because by influence, I mean there is an enormous difference in the outcomes depending on those multipliers. So the wealth formula in its simplest form looks like this. We have capital deployed, right? How much money we can invest, multiplied by our compounded annual growth rate, right? What kind of returns can we get year in, year out, and multiplied by time, right? So of course, the longer we are, playing the game, the more interesting it gets, right? And this equals wealth, right? So that capital deployed is the money that we put into the market. Our money, you can think about them like little soldiers going into war, right? And you want them to bring more money back. And how much money are you able to contribute to our investment account is especially important during this initial phase, right? Because in this, document here, I was especially focusing a little more on that path from 0 to the first 6 figures, right? So it's important how to get that initial engine running. Because 20% return on 10K, that's just extra 2K. Not so much, right? But 20% return on 100K, that's 20K, right? And it becomes more and more important over time. So as Charlie Munger said, the first 100K is a bitch, right? But you gotta do it. Any means necessary. And he said that in the 90s. So with inflation, as I've already mentioned in this video, right? Probably going to be somewhere, 200, 250K. Yeah, that initial part sucks the most. But it's only going to get easier from here. Good, right? So the main point is that we have to get that seed money, right? And for most people, they just come from earned income. We want to maximize our earning potential. That's a priority. And of course, also, keep our spending in check, right? Don't get caught in the trap of lifestyle inflation, right? Always have decent amount of money from your paycheck should get to investing. The more, the better. And once you cross 7 figures, of course, our earned income is not going to be that much of an important, right? So, especially in those initial phases, below 6 figures, we have to put lots of money in, right? As the time goes by, it becomes little less important how much are we putting in, and more important are the returns that we are getting, right? So that's also that priority shift, right? Under 6 figures, just find a way how to make more, put that money into the market. And then, of course, first we have to little brute force it. But once we cross into that 6 figures, it's also become, okay, now we need to be smart about managing that money that we've accumulated. Which brings us to that second part, right? CAGR, aka compounded annual growth rate. And that's that multiplier for our portfolio, right? Because if you would make it a chart, it would basically mean how steep of an angle towards the peak, right? Because compound interest is regarded as the 8th wonder of the world by Warren Buffett, right? Because it's a huge difference. If we just get those, let's say, 10% per year, which we can, roughly expect from an index fund, from the market, if we just put money in the index fund, call it a day, put our feet in the air, cool. Then, over a period of 30 years, we're roughly 17x our money. Cool, okay. So if I invest today, 1,000, it's going to turn into 70,000 in 30 years. So lots of people there, there is a big lobby, of course, of all of those index funds, because it's in the fund's best interest, right? To just, lure people to get their money in the index fund, let them manage it. And sure, for many people who don't want to do the work, hey, be my guest, right? But if you actually become a competent investor and get, let's say, 20% annually, over 30-year period, you 237x your money. So for every 1,000 invested, you get almost a quarter million back. Right? And that's crazy, right? And of course, 30 years is quite a long time, right? But, you can shorten the timeline. You can see what's possible just in, 10, 15, 20 years, right? Already here you're getting into crazy numbers. So, there are two types of people, to be cheeky about it, right? Either people who understand compound interest or poor people. So there is this machine that exists, right? And it's just up to us to, take advantage of stock market. And so basically, at the end of the day, that compounded annual growth rate, right? The returns that we can get year in, year out. That's the difference between millionaire and a billionaire, right? It's a completely different league. And that number also puts quite a pressure on investor, right? Who wants to go above and beyond and get those 20%, right? Because that's also definitely not easy, right? To get those 20%, like we have to be good, like really good, again, income statement, balance sheet, right? Understand the business, be able to extrapolate into the future where the business is headed, right? To figure out if it's a good investment that can actually provide these kind of returns. So that's where the, nuance and the tough parts get, right? And so it's of utmost importance to make a correct decision, right? Because let's say we have 10K to invest and we are deciding into two companies, right? Let's say, this year I have a 10K to invest, right? Which, there's, like imagine that we are kind of investor starting out. We have 10K to invest in the market. And let's say, there are two companies, right? And the first one over a 10-year period, the stock price rises from $10 to 100, a 10-bagger in a decade. That's a strong result, right? Freaking amazing, 10x our money. Well, and over the same time, let's say the company B rises from 10 to 20, you doubled your money. It's good, but it took a decade, right? Ooh, that's tough, right? So that's a huge difference. And you really need to, put that work to identify as many companies that are more like the first one compared to second one, right? That's not easy. There are many companies that just stay, somewhat stagnant or just provide returns in line with the market, right? So we just have to be, smart about it, because let's say if the market brings those 10% annually, and to simplify it, let's say you have those 500 companies in S&P 500, and well, it's 500 companies, right? Well, and as a competent investor, you have to be able to identify, let's say, the top 10% of the companies, right? And invest in those instead of some average company or even, bottom 10%, right? So we're just basically getting more narrower, and we have to make better choices at the end of the day, right? Because the difference between the results is enormous, exponential, right? So you want to be correct about the decision you're making today, not just make a mediocre decision. It all comes down to the quality of our decision making, right? That's why, that Kager is so important. And of course, at the end of the day, you have time, right? That's the one that we cannot really impact. It just flows in one direction. We all experience it in basically the same way. And so the only way we can influence it is to, of course, start investing as soon as possible, right? If we are in our, 20s, perfect. And once again, I wrote this, when I was I was like roughly 25 when I wrote this, right? Because your 20s, if you're still in your 20s, they are damn important, right? If you want to, you want to make hard decisions early. But of course, even if you're, already in your 30s, 40s, 50s, maybe still just starting out, cool. You'll still have at least that decade in front of you, right? And within a decade, if you do things right, it's still decade to $1 million, $2 million, not unreasonable. It takes work, sure, but not unreasonable. So those are basically the three main points, right? And that's basically the important point, right? And to do one more lesson number 2, the long game, right? Which ties to this, time frame here. Because also the longer we are playing the game, the more outsized the result, right? It's a stock market's a multi-decade wealth multiplier. It starts small in your first, 2-3 years. And at least when I was starting, I remember I was kind of questioning myself, like, hey, does this actually lead somewhere? Right? Because at the beginning, I was investing in just some index funds, some, kind of like a big names, Apple, Microsoft, the usual guys. And I have first 10,000 in the market and 15,000 in the market. So sure, I had some returns, but it was just like, okay, let's say from my 15K portfolio grew into 17, cool, extra 3,000, but is it really changing my life? It did not yet, right? Because the longer I've kept going, the crazier it got, right? So, when let's say, and you can see that compounding chart here, the scenario that's outlined, starting with 50K, adding 10K per year, right? So not even 1,000 per month. Compounding at the rate of 20% gets you to 20 million portfolio in 30 years, right? Roughly. And of course you can, pick your own, do you want to just get to 2-3 million, call it a day, retire? Hey, fair enough, I'm not judging, right? I mean, I'm definitely going for more interesting number than that. But whatever your goal is, you can basically make this calculation and see, hey, what do I need to do in order to reach to my number or what I'm aiming towards? Because, imagine where, and this can get even crazier, right? If you're, let's say, investing more, right? And sure, there will be days you will be doubting your progress because we always see just like that, small surrounding, the small start. But when we zoom out, the progress over 5+ years is eye-opening, right? Because you might be starting with first couple thousand, it starts small, but then suddenly in, couple of years, like this looks very small, right? Compared to that final outcome. But already here you are in, 6 figures, multi-6 figures, then there is somewhere, 1 million over here, right? It's just about keep going, keep stacking, right? And to now go one step further into the actual portfolio, composition, we also have to understand, what kind of investor are we, right? So one of the, simplest and very straightforward ways how we can structure our portfolio is do that little bit balanced mixture between growth, value, dividend, right? Because generally speaking, there are 3 broad categories of stocks: growth, value, dividend, right? Some investors prefer one or the other. Well, we should love them all, right? Because the market, of course, keeps turning over, and sometimes one of those categories are a little bit more favored than the other, right? So we have to understand them all, right? Because as the time goes by, different years, the market is basically, you have to go a little bit like a counter market, right? Because let's say 2 years ago, back in 2022, there was like this, deep bear market, and lots of those high growth names were just like so discounted. It was time to buy lots of those, high growth companies. Now, not so much. Sure, there are still some deals, but actually the valuation in tech and, high growth names are a little bit on the higher end now, today in May 2025, right? But lots of the value names and dividend names are, for example, at quite fair valuation at the moment, right? So we should be able to navigate between these different categories. So because, if we simplify it, growth stocks usually outperform value stocks in the short to medium term. However, value and dividend stocks offer stable growth over very long periods of time, right? So it's also, it's never as easy as buy or sell. It's also, hey, do we know what we are getting into if we are investing in so-and-so company, right? So basically, we should be a little bit, jack of all trades, right? And understand all of these. Of course, if we become like really competent investor and want to focus on one thing or another, hey, we can. My portfolio is also a little bit more, growth oriented. My personal choice here, I'm definitely more on that, riskier, quote unquote, riskier side, focus on growth. But we should understand all of the categories. But yeah, I think that's about it for today. So of course we will continue this, and I was actually thinking of making these into 2 videos, but seems like I'm yapping too much. So maybe we will make it 3, 4 at least. So we've already made it to page 6 out of 17, and we'll continue later. Appreciate ya. Take care.